Just earlier this week, President Trump announced record tariffs that's frankly shocking the world, shocking the markets. And investors are wondering, why is he doing this? What exactly is going on? Who are the potential winners and losers? And I'm going to share also, towards the end of this video, my own personal playbook. What have I been buying just earlier today in response to this market chaos? So let's cover all that and more. My name is Daniel. You're watching Unrivaled Investing. Let's dive right in to understand, why is this market chaos happening? So first, earlier this week, President Trump, Liberation Day, announcing record tariffs. I think the market was shocked based on not only the size of the tariffs, 34% China, 20% EU, 46% Vietnam, 32% Taiwan, but that it was so broad-based around the world. And investors, I think a lot of businessmen as well, you're in this fog of war. It's chaotic. You have businesses that said, hey, we're moving production out of China because you've given us very clear signals. You're going to be tariffing China, so we're going to move it to Cambodia. We're going to move it to Vietnam. Oh my goodness. Now Vietnam has this crazy tariff. So you have businesses that are getting completely whipsawed. You have investors getting shocked by the scale of these tariffs. And by the way, the calculation for how they even calculated the reciprocal tariffs is bananas. It's almost like they plugged it straight into ChatGPT, because it's not actually based on what is the tariff that this country has on us, or what is the VAT taxes this country has on us. It's what is effectively the trade deficit that we have with this country, and what would be the appropriate tariff to potentially rebalance that out and wipe out a trade deficit. So it really is a bananas calculation. I think a lot of investors were shocked at sort of how elementary, rudimentary these reciprocal tariff calculations even were, because no one was expecting it to this degree. And one could argue this is an opening salvo, and that's what you've seen from the administration saying, hey, this is the ceiling. The goal is to bring you to the table where we start having conversations. So this is frankly really high figures, and it is shocking. It's shocking the world, and it's causing the stock market to crash. You are in this sort of fog of war where folks are saying, wait a second, you're making stocks affordable again. So why is President Trump, proposing this grand new deal? And, what does it mean potentially for investors? I think the root of it really comes down to this. The U.S. government last year spent around $5 trillion. Excuse me, they took in around $5 trillion, and they spent around $7 trillion. Obviously, that's not sustainable. Take in $5 trillion, spend 7. That means there's a net deficit of 2, roughly. And the U.S. government already had tens of trillions of dollars that it had to refinance. Interest rates were going higher. And then you say you can't just keep adding $2 trillion a year, especially, relative to the U.S. economy. So you're talking about 6-7% of the U.S. GDP. It was just completely unsustainable. So how do you tackle this? And this is something that they've actually been signaling for the last few weeks, one of which is cutting fraud, cutting waste. And you've seen Elon Musk talk about that, trying to apply modern, technology to look at the various different government bureaucracy, look at the different systems and say, okay, where is the potential fraud? Where is this, this person that's 150 years old that's collecting Social Security? Let's figure this out. Let's try to, save $1 trillion. That's the aspirational target. And so, if you are able to save, let's say, $1 trillion in expenses, and then you're able to raise another $1 trillion, and this is Howard Lutnick, the Commerce Secretary, who's on the same bandwagon with Trump, encouraging tariffs, then you can get, hey, $1 trillion from cutting expenses, $1 trillion raised from tariffs. Boom, you've solved the $2 trillion annual deficit. And that's sort of aspirationally what they're targeting. And frankly, they aren't the first to talk about tariffs. They aren't the first to say, look, America has had real challenges managing its deficit. And this is a case of Warren Buffett back in 2003, writing an article for Fortune magazine talking about how America's growing trade deficit is selling the nation out from under us. Here's a way to fix the problem, and we need to do it now. And he was proposing an indirect trade or an indirect tariff called an import certificate to fix the U.S. trade imbalance. But clearly, it would result in very similar policies. This would be more market-oriented versus the top-down, hey, we're going to set the tariff rate. But it is a very similar, implication, which is that you needed to effectively have some sort of tariff, resulting in higher cost of goods for the consumer, effectively a tax for the consumer, in order to get the U.S. trade better balanced, and that it was unsustainable. And this was over 2 decades ago. This was 2003 that Warren Buffett was proposing an import certificate. Now, people can change their mind, but I don't think, he's, let's say, become more confident in the financial solvency of the United States. Now, part of this proposal, I think this grand plan from President Trump and his administration is the view that, yes, if you can balance out that $2 trillion deficit and get to a position where you've reduced it, then maybe you can consider something, and this is literally something Howard Lutnick was talking about just a few weeks ago, that maybe you could abolish, the income tax for anyone making under $150,000 a year. And so now you're talking about how do you boost a lot of, the income for, let's say, everyone, middle and under in terms of America, higher middle and under in America, to give them more buying power. Is if you're able to, so there is this multivariable dances. Maybe you're going to be paying more for certain goods, and it's going to be, certain countries, but by the way, you're going to be taxed less. So you have this sort of dynamic that's going on. At least this is the grand plan they're considering. And admittedly, you're already starting to see different countries come to the table. You have seen Vietnam talk about, yeah, they're going to cut their tariffs. And so you could actually have a position where this is the opening salvo, cause a lot of chaos, but then you actually have, better trade with some of these countries, let's say in a few months from now. Not necessarily all of them. Some of the tariffs are going to stick. The question is how much, how locked in are they to say, hey, we're going to have it at a minimum of 10% tariff, even if you cut yours all the way to zero. That's a big uncertainty. We're in this sort of fog of war. But when you see countries like Vietnam, like Cambodia, they understand. They don't want to completely disrupt their economies. They're saying they're going to cut their tariffs on U.S. goods significantly. So in Vietnam, they're talking about bringing it to zero. In Cambodia, talking about, bringing it, I think, something like from 15% to around 5%, I think. So either way, looking at, huge cuts where they're trying to make it more fair. And in response, you're seeing the businesses that exported their manufacturing from China to Vietnam seeing a little bit of a boost today because they're saying, oh, things might actually work out. You might still be able to afford shoes in a few months from now. That's great. Now, who are the potential winners and losers in this dramatic shakeup? So first of all, I think it is worthwhile to look at what the market signals are saying. First, you see U.S. Treasury yields. This is a 2-year Treasury yield. It has been plummeting. Just a few weeks ago, it was around 4.25%. That's around Fed policy. Now it's around 3.7%. Oftentimes, this does lead Federal Reserve policy. So it does make me think you could see cuts, later this year. It does suggest economic weakness. It does suggest potentially sharp economic weakness. This does not suggest a rapid spike in inflation. That is not what the U.S. Treasury yield is signaling. It's signaling economic weakness. And, one of the beneficiaries, this is the Treasury Secretary Bessent, where, he had to refinance billions of dollars in U.S. Treasuries this year that were, in my opinion, improperly, set to mature in very short duration. Now he gets to roll that over, possibly extending the maturities at a lower interest rate than he was looking at when he first entered, the new administration started. So he's potentially saving U.S. taxpayers, hundreds and billions in interest expense because of this environment. So it is important to understand there are going to be winners and losers. Now, if it does result in a true hard landing type of environment where unemployment starts picking up, then it starts negating the fact, because then you have, unemployment checks start going out. So there are these different, cross currents. It is a very tricky environment. So let's talk about the losers. Who's definitely losing in this environment. This is the past month. You can see S&P down around 12%. So I would say let's start with the going with Toast. Toast, you're talking about restaurants in the United States. People are going to have less money to spend on restaurants in theory, less money to go out, have fun, because all of a sudden goods cost more, discretionary spending taking a hit. That's what you're seeing. You're seeing companies focus primarily, let's say, on U.S. consumer goods, consumer discretionary, taking a hit. Nike, we already talked about the big impact from Vietnam and the challenges there. People saying, hey, maybe I can't afford my shoes. maybe trading down, you're getting a Skechers versus a Nike type of dynamic. But the ones that are really getting crushed, let's say Shopify and Carnival Cruise, the signal there when I'm seeing a Shopify down 30% in a month or Carnival Cruise down in 30% in roughly a month, that's really a commentary about global trade. That's a comment saying these global companies that are all about selling cheap tchotchkes and cheap subscriptions around the world for a consumer, that's being attacked directly by this brand new proposal. So that's why you're seeing Shopify. It was already expensive a month ago, but that's part of the reason why you're seeing that down 30%. This is a direct attack on globalism, sort of saying, hey, let's just sell these cheap goods from, this country, from China to the US. That's being disrupted. Then Carnival Cruise, once again, that's the levered global traveler. You're not going to be doing that because all of a sudden your expenses are going to be higher. And so that's what I look at from this sort of market development. Looking at some of the losers, it's broadly saying the consumer is weaker and global consumption is certainly going to get disrupted. That's what global consumer, global discretionary is certainly going to get disrupted. Now, who are some of the winners over the same time period? Well, Dollar General in the US, that's up 30%. That's a stock where people, clearly they're going to say, wait a second, maybe I can't afford my groceries in the way I previously was. So they're already starting to see a trade down effect where people were previously shopping at Gelson's or Ralph's. Now they're going to Dollar General. That sort of dynamic. You're seeing more people saying, hey, I got to shop here because I couldn't, I got to make my limited paycheck extend it more because the challenges I potentially face. So you have that dynamic. Weaker economy, more people going to the dollar stores. Another one, these are more stocks that are holding up versus the S&P, losing over 10% in such short order. Tobacco companies like British American Tobacco, where, here it is up slightly, year to date, because of how sticky it is in terms of pricing power, and they're beginning to offer more smoke-free products. That's more of a secular trend. Then you have home builders. Home builders benefit from much lower interest rates. Now, because when you think about the big aspect of when you're buying a home, it's the mortgage. The mortgage is 80% plus for some people, maybe even 90%. And so then it's what's the interest rate on that mortgage. And so, in this case, if you're getting much lower rates, then you're going to have more activity with home building. You're going to have more people being able to potentially afford their homes. And then lastly, this is Chubb, which is that insurance. This is also held up very well. And you can see a lot of insurance companies have held up quite well because world in chaos, you still need insurance. You still need, say, hey, if there's a fire at my factory, that I'm going to get some sort of payout, or if there's some sort of work stoppage, if there's a tornado, I'm protected. And so insurance holding up very well in this environment. So these are the examples. It's not the ones that are tied, let's say, to a strong consumer or, discretionary spending. That is not this. This is what are the rock solid sort of stable type of businesses that, should be around in 5 years from now. So what am I personally doing in this environment? I'm going to walk you through one example of a stock that I've recently been buying. As always, this is not financial advice. Also, quick plug, recently Dominic, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. He said, I've been investing for about 6 years, and early on I was just getting lucky. I had absolutely no idea what I was doing. Since joining your community in 2022, it has become by far the most valuable source of education for me. This follows Pinkle, who said, I've been with you for a year and it was a game changer for me. Thanks for creating this service. We have an excellent community. If you're looking for compelling ideas, come check out Unrivaled Investing. The rate, by the way, for the premium tier at Unrivaled Investing will be going up later this year. So now is the time to lock in the favorable pricing. It will not be this low in a few weeks from now. When I think about and what I'm considering, first, before talking about what I'm buying, because I have been nibbling on a few positions, but before talking about that, I think it is super important to consider this is potentially a shock to the system. And if the president does not walk back all of these tariffs, you could have some sort of unwinding in the financial system. And when you see, let's say a 10% drop in 2 days, that can be the beginning of something else. That can be the beginning where it starts getting momentum on its own, sort of like a snowball going down a hill. It just starts, you can start that initial push, but at a certain point, it just starts spiraling on its own. And that's my concern here, is that there could be a disconnect between the administration sort of being locked in and saying, hey, tariffs, 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 and missing the market signal that's starting to occur. You could have margin calls. You could have investors caught off sides by this, saying, I was not expecting 10% tariffs at a minimum across the board. That, wasn't part of my playbook. And I was levered 150%. And now they have to, take off their leverage as their portfolio just sold off 15%. So you have that dynamic. So you could have, I would say, real collapse next week. That is possible. That is something for investors, to consider, is that these things can start getting a life of their own. And this is a shock to the system. No one knows exactly how this plays out. That said, I am following my own playbook. And the playbook, frankly, doesn't change whether or not, you have President Trump on TV or someone else, or, you have one economic policy or the other. I'm mindful of the macro, but my North Star remains the same checklist. I want aligned management. I sleep better at night knowing that they're tackling the problems of their business, and maybe they're the founders. I want a compelling valuation. In this environment, I prefer companies where you have that positive free cash flow, and that makes me feel a little bit better, because then you say, hey, if you have that positive free cash flow, maybe you can buy back stock, or maybe you can buy some really interesting opportunities if someone really sells off. I think also, and this is something we all can do in this environment, which is focus on the companies where you think it is just obvious that it's going to be much bigger in 5 to 10 years from now. And if you're saying, hey, I'm relying on global trade like a Shopify, that is a much trickier situation. Global e-commerce, more and more businesses around the world that get onto the Shopify platform, and then they're going to be trading with people around the world. That is a harder bet. Might still work out over time, but that is a harder bet. What I would say is focus on the niches where you say maybe it's a regional market, or maybe it's a very, it's a very targeted market where you say, yeah, this company already has 20% market share, and here's why I think it's going to 30, or why I think this market's going to keep growing, and they already have, a dominant market position. They already have the number one position. Why they deserve to win. I'd love to read your thoughts, by the way. If you have any companies that you're like, I have strong conviction that this company deserves to win in this market, feel free to leave, comments below. And I will definitely consider looking at it, in the future. I'm personally, what I'm using is flash.stocksentinel.ai, free tool for the companies that are already there, $5 for new company reports, where it's just, if there's any ideas, can quickly upload them there. And that way I can quickly get a sense of, is this compelling for me personally? Does this journey, do you have that founder alignment? Do you have all these things on here? So it's really helpful for me and my own personal first stab at looking at a company. So I'm looking at this and I'm thinking, most companies aren't going to meet this, but there are still going to be some situations, even if you have economic chaos because of tariffs, or you think that there's going to be obvious growth. So let me give you an example of one thing that I was recently buying, and that's Coupang, CPNG. That's the ticker. Literally was buying earlier today. And, they're known for saying this is South Korea. This is the dominant e-commerce platform in South Korea, where, they like to say, create a world where customers wonder, how did I ever live without Coupang? I've even done videos on Coupang in the past. So in full disclosure, I own shares in Coupang. I was buying some earlier today. And so the reason why I was buying, yes, I do think tariffs can disrupt the South Korean economy. Car exports are a big part of their exports, especially to the US. You could see emergency policies in South Korea as they react to this. There could be real economic contraction and a tougher environment in South Korea in response to this. So I'm mindful of that. But I'm also mindful that all their cohorts on the Coupang platform, they've been spending more and more money on their platform over time, including their oldest cohorts. So the ones that have been with Coupang for years. And that's because they keep launching new and better services. So that way you can order, let's say, your groceries at midnight and it'll be at your door that next morning when you wake up. So I like seeing businesses. I like seeing the founder-led businesses. Coupang's one of them. They have a huge cash balance. So this is an example. Regional player dominating in South Korea. Yes, there will be economic challenges in response to tariffs, without a doubt. But 5-10 years from now, if you're able to zoom out a bit, do you think South Korea will be bigger? I do. I think there will be some challenges in the near term. Absolutely. But do I think 5-10 years from now, South Korea could be bigger from an economic perspective? Yeah. Do I think Coupang could be much bigger in the future? Absolutely, especially because they have a well-articulated policy of saying, yeah, we think our long-term EBITDA margins could be 10% plus versus 4.5% now. And they have, a steady track record showing, smart capital allocation and slowly improving operating margins. So I like to see what they're doing. And this is an example of a stock that I was buying earlier today. I think they'll be bigger in the future. I think they'll be much more lucrative, much more free cash flow. And, they have the dominant position. So that's an example of something that sort of fits my own personal checklist. I hope this video walking you through this tariff chaos has been helpful, understanding why is it happening, understanding who are the potential winners and losers, my take on it, and an example of one of the types of companies that I was buying earlier today. There were several others that I was buying more of, but this is just one example. And so if you're looking for more compelling ideas, come check out unrivaledinvesting.com. Thanks so much for watching.